So 2 months ago, I lost over 50% of my investments due to common investing mistakes. That's why today I'm going to speak about the most common mistakes that most investors are making and how to avoid them. So the first mistake is only investing in companies that you know. Everyone always goes through that first beginning stage where you know about the Teslas, you know about Apple stocks, you know about Amazon, and you decide to buy these companies just because you know that they are doing well. Now, yes, they are more popular, but usually there's things that you want to find out that could be going wrong. You generally don't want to invest in just companies that you know. There's a lot of research that you want to do at the beginning because there's a lot of companies that work behind the scenes that are making a lot more money, that are actually doing well, that most people do not know about. So this also means that these companies are less volatile compared to the Apples and the Teslas that people continue to buy and sell every single day. So to be honest, the best thing I can recommend is just experience. After investing for a few months and you kind of get the hang of losing money and earning money, you sort of understand what to look for. You want to understand what the terminologies mean. You want to know exactly what company does what, so that way you know exactly what your money is going into. If you're going to invest in dividend stocks, for example, just search up the dividend kings and dividend aristocrats. These are good companies generally that a lot of people are aware of, but that's because they are good. That's because they've been doing well for over 50 years. Some of them have been doing very, very well for over 25 years. So they do have some sort of solid background, and these are companies you can start off with. Next, we have only owning a few amount of stocks. So simply put, the biggest issue from this is not diversifying enough. If you put all your eggs in one basket, once something happens to that basket, all your eggs are potentially going to get lost. So you want to invest in multiple baskets. So once the first basket breaks, you have a ton more basket that is still holding all your eggs. So this is why a lot of people speak of the S&P 500 because it's the top 500 stocks in the US. So this means if anything happens to even 10% of that 500, there's a lot more companies that are still going to hold the entire basket together. Your stocks will continue to do well. And it's even better if you can dollar cost average. So this is you investing money at a set time. So you can invest money every single month, every single week, but you want to continue doing this consistently. And what this is going to do is your money is going to be spread out because you would have bought all the different stocks at different prices, you know, over several years. Next, you don't want to forget to reinvest your dividends. It's very nice and sweet to be earning passive income from dividends, but if you're spending this money, you are losing out on a ton of passive income that you can be making just by reinvesting this money. Compound interest is one of the biggest ways to why the rich continue to get richer because they are putting their money to work. All these dividends that you're getting, that is free money, you don't want to withdraw it because you're going to have to pay tax on it first of all. And secondly, once you can put this money to work, the amount of money you can make is ridiculous. For example, if we're looking at the FTSE and you can see the difference between someone who's actually reinvested their dividends and someone who hasn't. If you don't reinvest your dividends, you're getting around 30k, and if you do, you're getting around 100k. Now that money clearly is extremely significant. So you want to always reinvest your dividends, and most platforms these days also offer the option to have your dividends reinvested automatically. So that way you can take the most of compound interest, especially if you're investing from a very young age. Then this would mean that you have at least 20-30 years to have your investments work for you. So to take a look at my investment, I opened this recently and it's been doing well. I'm almost up by 10%, and I have this portfolio split where I have 90% in the S&P 500 and I have the remaining 10% in electric vehicles and clean energy. I've left it there as all passive. Everything is being reinvested by itself. The money is being invested by itself. And this is already almost up by 10% without doing a single thing, which is just good. And I have the auto invest all set up. And based on the valuations and the projections and everything else, it's saying that in the next 22 years, I'll have around 57k invested. And that is projected to grow to around 430k. And that is all going to happen passively with just me investing a small amount at the moment. Of course, as I continue to grow and earn more money, I'm going to invest even more. So this will hopefully grow to around 1 million in the next 22 years. So this is just a simple example of how you can put money into the stock market, put money into just a handful of stocks and just let it ride the wave. Next, for the biggest mistake of all time, this is buying high and selling low. A lot of people, when they first start investing, they want to buy the companies that they know, and they buy these companies at a high price because they're very, very popular. They usually just buy in, and that is usually at the point where the company is just very expensive. And once you buy this stock, when it begins to go lower, the fear of losing money kicks in, and you then sell your company or you sell your stock at a low price. Then you get the urge to buy back in, and you continue this routine of buying and selling and buying and selling. So look, the number one thing I'll tell you is that you can never time the market. The market is extremely difficult to time. Several research that has proven that most people that try to time the market lose more money than just investing into the S&P 500 and leaving it and letting it grow. So I just recommend just investing when you're ready, have a good plan, have a good amount of money that you're going to continue investing every single month, and just stick to it. And for the next one, we have being too greedy. Now this is when you have invested your money and now your money has actually grown and you're just being so greedy that you don't want to sell. Now this is for those who actually sell. I personally I try not to sell any money that I have invested into the stock market. I have a plan that I know I'm not selling it for at least the next 5 years. Sometimes when you see that you are actually getting a lot of money, you just have to sell, because once you don't, there's usually a time when it all tanks. and all that work that your money have done is just going to be pointless. So I'm able to say this because this happened to me. I've been there, and 2 months ago I had my money, I had everything reinvested, I had everything going smoothly. My portfolio was extremely high. I was invested into Tesla, into Fiverr, into Apple. Everything was going all sweet, but eventually it all came tanking and I lost over 50% of my investment. So you just don't want to be greedy. Now, if you are finding any value in the video so far, then be sure to do me a favor and drop a like, and do subscribe for more videos like this. But for the 7th option, we have ignoring relative performance of stocks. So now in this day and age, there's several ways to find the data out there. So different platforms actually do show you the performance of stocks, 3 months ago, a week ago, a year ago, 5 years ago. Now these are actually important. It's good to always have a brief look, have a brief idea of how a stock has been performing. Now there's some stocks that you will see that has just been peaking. There's some that you will see that have been tanking, and there's some that are kind of level. They're always going up and down, up and down. Now these actually say something about these stocks. These are things that you want to look at before you invest, but not just that, you also want to look at how much money they've earned, their capital, their dividend payouts and everything else. For example, there's an app that I use, and this is Duke Energy, and I can see when their dividends are going to get paid. I can see their ex-dividend dates. I can also see their earnings since 2021, and we can see that it's increased some months, it's decreased some months. So this is something that I can use to then make a decision if I want to invest. I can also see how much their dividends has grown. So we can see that in 5 years it's grown by 2.46%, in the past 3 years 1.71%, and in the past year 1%. So this does show that the dividends continue to grow, and most companies are able to grow their dividends. It does show that they're actually earning some sort of money. They're able to afford to keep paying out dividends, so it usually means that the company is doing well. Most companies that actually cut their dividends, this is a good indication that their capital might not be stable. And if I want even more information, I can also see analyst ratings. I can see what people are saying about these companies. At the moment, most people are saying you should hold Duke Energy, and some people are saying buy, but no one's saying sell. So these are tiny indications on what you should do before you actually buy a company. Before you actually invest, I would definitely recommend you look for information like this. You want to find out exactly what these companies are about. You want to be 100% sure that your money is going to be saved, because this is money we're talking about. This isn't some sort of fake currency. Your money can actually get lost in the stock market. So you want to make sure you're 100% confident, and you want to use these information before you invest into any company at all. Next, we have following the buy and hold strategy blindly. Now, of course, earlier I did say that this is something I do actually buy and hold for the next 5 years at least. But I mean, it's not the worst advice out there. It's generally good to buy and hold, because usually what goes up must come down, and what goes down must come up. You get the idea. Once you do buy into the stock market, especially once you buy a very, very good company, then you'll generally save if you invest in the long term. But doing this for the wrong company is a very, very bad idea. That's why you don't want to follow this blindly. Investing into the wrong stock that has just been tanking for years, and you continue to hold it hoping it's going to recover, is a bad idea. A friend of mine did that about a few months ago, holding things like Fiverr. Fiverr just kept tanking and continued going down, and it did not recover. So there's just no point holding a company that is just dying. There's just a point where you have to decide and just sell and just cut your losses. So the holding time of each stock is relative to how well the stock has been performing. So I would usually say that you just want to look out for all of this information, then base that on if it's going to survive, if it's going to recover. If not, then you just want to cut your losses. So thank you for watching. I do hope you enjoyed the video. Again, if you have found any value, be sure to drop a like, and I'll see you guys in the next one. Peace.